Well, good afternoon, everyone. This is Futures Brizio here. We're going to talk about the markets. It is Thursday, June 4th, 2026, 3:20 p.m. New York City time. Before we get started, make sure you smash the like button and subscribe to the channel. Really helps out. And any questions or comments, please leave them down below. I really appreciate it. Again, I don't sell anything on this channel. It's just my take on certain markets and how I trade, and that's really the purpose of this. And if you can benefit from it at all, perfect. If you're watching it just for entertainment purposes, which is how I watch a lot of trading videos, that's fine too. If you think I'm full of it, you can tell me that too. So, but I'm always up for conversation as long as it's respectful. So, anyways, I hope everybody's doing well. It's been a minute since I've been on here, probably about 2 weeks since my last video. I have to go back and look. I was out of the country last week for about 8 days, and I did get back over this past weekend, but just been really busy doing all this stuff. And so I just haven't had time to really want to get in here and make any videos. So I'm going to do that today, obviously, and we'll jump right in. So first of all, I want to talk about futures a little bit. And as you can see over here to the right, my little list here, you can see that I got rid of all my currency futures. If you guys know, basically I'm trading Forex on my funded account, and I also have a small personal account that I mirror the trades on. And for futures, I only trade on a prop firm account. I did have a small personal account. I'm not using that right now because a lot of my focus has been in Forex, and so it's just was spreading me a little too thin. But I still have a futures funded account, so I still do trade, but I just use this stuff right now. And so, in order to kind of pare back the crazy number of markets I was trading, I just decided to get rid of the currency futures, especially since I'm trading Forex. That's enough exposure to currencies. And so I've just kind of, knocked it down to these basically 5 or 6 markets, basically the grain markets. And I do have cattle on there too. That's LE. This right here is cattle. This is soybean oil. This is soybean meal, soybeans, corn, and wheat. And I've just basically gone back to essentially just day trading these markets. Now, Forex, I'm still swing trading because I'm just not a big fan of day trading Forex. Just it's too manipulated and volatile. But I think if you swing trade Forex on like a 4-hour chart and higher, that's great. I think that's very doable. And as you guys know, I use the currency strength indicator, which I'll talk about a little bit. Some additional kind of experimenting I'm doing with that in terms of time frame and settings and all that. But that's still the core of my Forex trades. But for futures, I've gone to basically just what you see on the chart here, which is essentially a simple moving average and a trend following system. And so, a moving average system looks great in hindsight when the market's trending. For instance, this downtrend that started back on, now this is a 1-hour chart. It's the other thing I wanted to say. I'm really just day trading these. I don't plan on holding these trades past the session. Although one I had on yesterday, I did forget to close it at the market close. The grain markets close at like 2:20 in the afternoon, some weird time. And I forgot to close it. So then they reopen again around 8 p.m. for the electronic overnight session. And I went in and closed it at that point last night. So that was fine. It ended up being okay. I was a little concerned because sometimes what happens when the electronic session opens, you could have been in a nice profit heading into the close. And then as soon as the overnight session, all of a sudden you get this big like gap, in this case upwards, that like, oh God, you just gave back half the profit you made during the day session because you forgot to close it. Fortunately, that didn't happen. The market actually drifted a little bit lower when it opened, and I closed the position. But anyways, using this again, I have it set at a 34. You can see it up here. Simple moving average, 34 period. That's all this is. It's just a basic generic SMA. And why 34 periods? 34 is a Fibonacci number. I don't know. So, people like to use 50 and 10 and 20, 21, 100, 200. Those are all kind of like a lot of the common, nine, if you want to get down to really short ones, nine or 10. 34 is a Fibonacci number. I have no idea if that really means anything in terms of how it writes. But in terms of this market, which is wheat that you're looking at, this works really well. You can see that every time this thing pulled back and tagged the moving average on the way down were textbook entries. Now you can use this with regular candlesticks. You can also go over to Heikin-Ashi candles. And basically, as soon as you see these blue candles represent the pullbacks, right? And then as soon as you get a bear candle, which on my chart they're purple, then that would be an entry. Okay. But whatever, that's really not the important thing. The important thing is you can clearly see these entries and they come at different times, but for the most part, these entries come around the market open. Sometimes they come a little earlier, sometimes they come at odd times. If they come in an odd time, well, if I'm in front of the chart, I might take it. But if it happens during the London session, like the early morning before I'm awake, then I'll miss that trade. I'm not chasing these. But you can see these. I took two trades, one today, I took one contract yesterday. You can see I took two today. And all I did was wait for it to get up to these moving average. And, in this case, this was yesterday's. You can see my entry. You can see my exit. This is where I got out. You can see the exit was at 8 o'clock. Because remember, I told you I missed the close of the session. So when the market reopened at 8 o'clock, that's where I exited. And it actually went down a little further. This was my closing candle. It actually went down for another 2 hours after that. I could have held that, but I'm fine with that. And then today I got in again. This was right at the market open at 9:30. Um, it says 9 because it's an hourly chart, but the market doesn't open until 9:30 officially. So, but I had a pending order sitting there, and I was not home this morning, so I actually put a take profit basically back at the yesterday's lows. Hit my TP. This little move here was about $1,000. This one here was about 750. It's a longer move, but I only had one contract, and that's it. And so you can just repeat this process for as long as the trend goes on. Now, it's important to look at higher time frames to kind of see like where this trend might die out or at least pull back. And you can see we're not quite there, but there are some lows back here on the daily chart. You can see to the left here. So as this comes down, I do expect that it will begin to slow down as it gets closer. It doesn't mean it's going to reverse, but because we are trading well under this moving average on the daily chart. But it's a reference point to where uh, you might see some support start to kick in. So we kind of draw a line here. We can go back to the hourly chart, and there's that line right here, this yellow line. And so let's say tomorrow, we go into the session tomorrow, and this thing is pulled back again into the moving average. I could definitely feel comfortable still taking a short here. Uh, in that case, I probably would have put a take profit again, maybe just below today's lows, but certainly uh, above this yellow line, which represents kind of the close of these lows down here on the higher time frame. Okay, so it's a very simple process, and if we just scroll through some of the other ones, you can see I also took this one in corn, although this was a couple of days ago. Unfortunately, I really should have held this one, but this was another day trade, and you can see there was another entry yesterday in corn. Now today, if you're going to follow this system exactly, this was not an entry. It did not come back to the moving average. It did end up making a new low, but it did not tag the moving average. So I did not take this trade. I should have taken this one yesterday, but like I said, I've been a little busy, and so I'm fine with the ones that I took. And kind of the same thing here. Right now, all these grain markets are trending down. This is soybean oil. A little bit more erratic in terms of when it breaks these moving averages. You can kind of see this kind of thing. And in hindsight, you can tell, but in real time, this actually looked like, maybe a long setup, right? Broke the moving average, failed to put in a new low, came back, tagged the moving average as support, and then went up again. And then finally it broke down. So it's not always going to be picture perfect. And some of these markets are a little bit more volatile, and soybean oil certainly can be. Um, And so we talked about corn already, soybean meal. Um, and this is the other thing. Moving average strategies are awesome during trending markets. They're absolutely terrible and useless during sideways markets. And here's some sideways. This is soybean meal. You can see from about May 20th through the 26th. So for about a week, we basically chopped around, but you can see the moving average is flat. But obviously, you might not know that until you've taken a loss or two before you realize, oh, this is a sideways market. But you can see, once this sideways pattern kind of kicks in, there's no trade in here at all. But then, we get back to the short, and then, we have an entry here, an entry here. This one's not great, but maybe you could have taken this one. It's not always going to come back to the moving average, and no one moving average length is going to be perfect for any one market. I mean, if I change this to like let's say I change it to a 20, maybe that will line up a little better for this one. Yeah, I mean, that makes this one a little bit better than the 34. But overall, it's still the same thing, right? The trend is down, and that's fine. So that's it. So that's basically all I'm doing with futures at this point. Here's this is soybean oil. Sorry, the first one was soybean. This is soybean oil. You can see clearly in a downtrend now. The moving average obviously is a lagging indicator. And so but you can see we're definitely in a downtrend. So I will wait, because of these giant bearish candles, the moving average is really lagging because it just hasn't caught up because we had these two gigantic bearish candles. And so that again, the moving average is a lagging indicator. But this will catch up, and then hopefully what we'd like to see again with this, assuming this downtrend is going to go on for a bit, we want to see some sort of pullback. The moving average will as the hours go by, will catch up with this price action, especially with these big bearish candles as we start to get past the look back on these old highs up here, because it's obviously doing a 34-hour look back. So it's still accommodating all these highs up here. But as we get further away from these highs, the moving average will speed up and start to catch up with price. And then at that point, again, we can look for some kind of pullback. I don't know where the moving average will end up. I'm just saying, like, for instance, right here. And then we can look for entries. And you can see, looking back at previously trending areas, the 34 can work really well like it did here and here. But it can be a little bit too long, kind of like we saw with soybean meal. So maybe I shorten the length of this down to like 21 or something like that, just so you can be more precise with like this one, this one, this one. These are all valid entries, but you didn't quite get back to the moving average. And again, you're going to use market structure to kind of time these out. So again, like 21. Let's change it to 21. And you can see that calls these higher. Now, you can look at this and say, well, look how much it broke below the moving average. That doesn't matter, because remember I said you're still looking at market structure levels. So the moving average is just kind of a guide, like to tell you, okay, has it pulled back enough? Has it pulled back enough? And I want it to at least get to the moving average. And if it breaks below it in this case, that's fine. But at the end of the day, it did not break this structure. To me, this is very obvious market structure right here. Didn't come anywhere close to that. And so this is completely valid. And then this is a great entry. I mean, this was at 10 o'clock in the morning. Perfect textbook entry. You see the market open. This is the 9 o'clock candle. It pulls in, people that want to go short. Maybe they're on a 5-minute time frame. They see this bearish price action on the 5-minute or something. Or they just think that, the market's going to reverse even if they're on this time frame. And then all of a sudden, they sweeps all the liquidity. You get this big wick, and then you close higher. Then that's your telltale entry right there. And this was the ideal place to get in during this candle. And then you can see it went up the rest of the day. Okay, so what look back period you use on the moving average is not critical. It's really just a tool to help you, again, gauge, has it pulled back enough? But again, one moving average length, you can see some of these like wheat, the 34 period is fine. Some of these soy complex ones, the 21 is better, So do you have to change it? Yeah, maybe you do. Maybe you just have, you either just go into the settings as you go through these and change it, or you have, maybe keep two moving averages on your screen, although to me that would be confusing. or just create another template, create one with the 34, one with the 21, and then you can just quickly just change the template and be done with it. So whatever works for you. So, and then this one is cattle, which I don't trade a lot of. Cattle is very volatile. You can see the price action is not really very pretty here. This is one where I think the 34 is probably better just in terms of smoothing this out a little bit. I mean, we got a little downtrend here. We have clear market structure adherence, right? Here's a short right here. Price makes new lows, comes back, breaks the moving average, but it's still below this structure, comes down again. Here it tags moving average, comes down again, and then we reverse and start going higher. Okay, so maybe this would have been a loss, right? You see this thing come up, and then you short it right here, thinking because in real time this probably looked like a good entry above the moving average, like it did right here. Market structure really wasn't broken at that point. So that one probably would have been a loss and this thing went up. But, you would have had potentially 3 winning trades if you took this one, this one, and this one, and 1 loser. So you still would, theoretically should still be profitable, if you have 3 winners and 1 loser, right? As long as your risk was the same on all of them. All right. So anyways, you can do it on any market. This is not my favorite market just because it's the volatility. Not that the grains cannot be volatile. But you see there's a lot of gaps on the chart, a lot of big wicks. It just doesn't lend itself well to this sort of methodology. So I don't anticipate I'll take a lot of trades in cattle, but if there's something really obvious in a trending phase, then I probably would consider it. But for the most part, I'm going to just stick with the grains, and that's it. I'm not doing anything else with futures at this point. Not that I don't like it, but I just need to be a little bit more focused than I was. And like I said, I took everything else off my watch list. Okay. So now going over to Forex, I got to change my template here. And we'll put the CSI indicator back on here. Okay. And you can see I don't have any other indicators at the bottom. So I'm just using the CSI. Now, you can also see I'm on a 4-hour chart, and I have made multiple videos. I'm not going to go back and talk about them, but I have videos, demonstrating this on the 4-hour, on the daily, on the weekly, and you can use this literally on any time frame. But just like anything else, the lower you go in your time frame, the more chance that you'll have a false signal. B, you probably won't be in the trade as long unless you just you happen to nail an early entry to a new trend. That's fine. But using this indicator, which is definitely lagging the way I have it set, I just don't find trading it on the 1 hour is worthwhile. I don't think, probably 80% of the entries are going to be very short term day trades, and I just don't want that stress level. I rather just swing trade Forex, and I'll day trade futures, try to grab some quick moves in futures, because the way the futures market work anyways, especially in the grain, particularly in something like grains, just so you know, and I talked about it, I mentioned it anyways, grain markets are only open for about 5 hours a day, right? They open at 9:30, they close at like 2:30. Okay. So if there's going to be a move in the grain markets, it's going to happen quick. It's going to happen probably right around the open, within, a half an hour to an hour of the open. It's going to make its move, and then it's going to be done for the day. Okay. And then the rest of the day, the market will just go sideways. So they tend to lend themselves very well to day trades, to like in and out, where you're in and going to be out within a few hours. Okay. They're not scalping. I'm not taking 5-minute trades, but an hourly trade is perfectly legit for me. And using, like I said, the moving average to kind of like judge, is a pullback sufficient enough? They're not always going to work, because sometimes eventually you're going to get a reversal and price will start to go, if you take a short, price will start to go down, and all of a sudden it'll hit a higher low and it'll bounce, go higher, take out your stop, and you'll be done. So that's going to happen. You're not going to win every one, but that's the benefit of day trading something like grains, because they are very limited trading markets during the day. It's not like, the NQ, like, NASDAQ and S&P, where they're open all day, basically 23 hours a day. You got to be able to, if you can't be at your chart around the open, to see and just take a quick look, see where price is, then it's probably not worth doing that, because you're going to, if there is an entry, you're going to miss it. So, and you don't want to be chasing price because again, once it starts to move, it's going to move quick and then the move will be done for the day. And then it'll just go sideways for the last couple hours and it'll, you're not going to benefit from that. You'll end up just losing money. Okay. So, anyways, getting back to Forex, you can use this CSI indicator again on any time frame. But again, with the volatility and the manipulation in the Forex market, I don't feel going anything under the 4 hour is good. Now, I was trading it. I was using 10-hour, 12-hour daily charts. I even tried it on weekly, and it's all valid. But I do like to be in the market a little bit more. So I'll just admit it. Whether you want to call that FOMO or not, um, whatever. But I'm still going to be, um, very cautious about, um, making sure that it's a valid trade. But just always just looking at the weekly market, at the weekly chart or even the daily, although the signals will be more reliable, you're just going to get so few. And so because I tend to want to be in the market a little bit more, um, I was tending to force trades on those higher time frames and getting into big drawdown. And ultimately, I might be right, but my drawdown would get so crazy because if you like buy at the top of a move, you get a signal on the CSI on the daily or the weekly, and you jump in, and then chances are the price is probably has already made its run up to a new high or down to a new low, and then you get in. By the time you get that signal, even with a short look back period, you're probably going to face a pullback, a corrective move. And on a daily or a weekly chart, a corrective move could go on for days, you know, or longer. And all that time you're in drawdown. And if you're on a funded account, especially that could breach your account if your drawdown gets too big. I mean, honestly, especially if you got multiple positions open or if you're over leveraged on your positions. So I'm kind of leaning back towards the 4 hour again as a kind of a compromise position. But at the same time, I'm like, okay, well, I'm going to go to the 4 hour, but I'd rather slow the indicator down a little bit. So I've been playing around with higher length look back periods. And you can see right now I have it set on 89. You're going to say, okay, why the hell 89? Again, it's a Fibonacci number. It doesn't matter. I've tried, 50, which is a standard, like moving average number people use. 55 is a fib number. And then from 55, the next Fibonacci number in this Fibonacci sequence is 89. So the difference between 55 and 89, when I did look back and back testing, is really doesn't make any difference. Honestly, the 89 is slightly slower, obviously, but it does what it does is it stretches these lines out a little bit, which I kind of like the visual a little bit more. And again, it's going to cause you that you're not going to get a lot of signals. You might go even on a 4 hour chart. It's possible you'll go a month, maybe longer, without a particular trade, any trade on a particular symbol. But that's fine. I don't care because I have 22 Forex pairs I monitor. On any given day, I'm probably going to get at least one trade, doing that. And so this is set at 89 and on a 4 hour chart. So, you can see some of these entries like this one right here are going to be banger, right? They come together here. We get this. Remember the way I have this color coded, the orange line is the lead currency, which in this case, this is the Aussie CAD. So this is the Aussie, the blue line is the Canadian dollar. You can see this is one of my favorite trades. There's basically two main types. There's the what I call the repelling magnets, or the kiss and deflect method, which is basically they come together and then deflect off of each other. And in this case is a bullish entry, basically on this candle right here. And then look at this nice run it makes up. Okay. And then we have another buy here. This one's not as strong, but you have one. If you try to look for a sell here, here's a sell one back here, right? Kind of another kiss. So the two types are basically the crossover type and the the crossover signals and the kind of the where they come together and deflect away from each other. Though when they come together and deflect away, those are usually continuation trades. The market was probably already trending, like right here. This market was trending down. You can see them kind of come together right here and then start to deflect away right about here. And this is the continuation. So they kind of squeeze together during the corrective phase. And then when it gets to a certain point where the trend's going to continue, you'll see them deflect away from each other. And that's when you want to look at your chart and say, okay, does that make sense? And you can see here on this particular, this is the GBP AUD. You know, we had a sell signal here. This was like April 26th, let's just say. All right. And then looking ahead here, we really didn't get another signal here until May 20. So it was a month later. We had a little sell signal right here. It was pretty short-lived because the market now is starting to come into a sideways. This was the beginning of this sideways action. Again, you don't know that going into it. You see the sell signal, you'd think you're going to new lows, and all of a sudden, no, you find out now it's sideways. And so we enter into this sideways. So we have a sell signal here, another little one here. These are all kind of crappy. There's nothing. Then we get another one here. This one's a little better. It looks nice, but price doesn't really go that far. And then we get a little buy signal here. Again, price just kind of like limps upward a little bit because, again, we're in a sideways market, okay? But by now, you can easily see that this sideways price action, okay? So you can easily just see, okay, well, maybe I just ignore any signals I get in this range until this breaks out. Once these highs or these lows get broken and the market starts to actually trend again, then I'll start to look at it. Maybe I just say, you know what, I'm just going to ignore any buy or sell signals inside of this range until we break it. Okay. And this is a 4-hour chart. This range could go on for many, many days, maybe a couple of weeks, but eventually it'll break. And we'll either break higher or break lower. I'm not going to try to figure that out. I mean, I go to a higher time frame, say, okay, well, I don't know. I mean, is this the bottom right here? And now we're just kind of accumulating. I don't know. And I don't really care. So I'm just going to wait. And when this thing, kind of breaks out of this consolidation, fine. And you can see what happens when it is consolidating. These lines tend to stem pretty close together because there's not a lot of volatility. The only real diversion was right here. We had this little run down to the bottom of the range and then came right snap back into it. Okay, there's really nothing else going on here. So this is what I'm saying. Like, you got to look at the price action and say, does it make sense? Are we in a trending phase or are we in consolidation? And if it's in consolidation, then maybe you just skip the trade, even if you do get a valid signal here. When it finally does break out, you will miss that initial entry because there will be an entry on the breakout, but you don't know it's a breakout until after it's happened. And then you might have to wait for a pullback. So, I mean, of course, you could take every signal here and just understand the risk and understand that you're in a consolidating market and that if you do jump in on any of these buy or sell signals, I would have, obviously very realistic expectations as far as how far it's going to go. So, you're going to be kind of in and out quickly. It might even be almost day trades, even though this is a 4-hour chart. So it's either better just to skip it, or like I said, if you do get in, have very, very reasonable expectations about where it's going to go. Until it tells you otherwise, then it's a consolidating market. Okay. So, so that's basically it, and a lot of these pound pairs are consolidating. You can see this is the pound USD. Basically, it's consolidating about now. Basically, yeah, since about 2 weeks ago, we kind of came up to here, and you can see, we did have a little spike in and out of this range, but for the most part, we just look at the bulk of this range. This is basically the range right here. We did have one little fake breakout right here where it went up for a couple hours, but essentially we're inside of a range. So this is just like the pound AUD, something like the pound New Zealand, on the other hand, looks like it's trending. We did have a little buy signal that came in back here. It's very late. So, but you can see, this little area right here might just be consolidation. If this is a real breakout, this will go higher. Now, if I miss this initial entry, I'm looking at this now and saying, I don't really like this because now both of these lines are moving sideways. So if I do decide I want to take this, I'm going to look for, this line to start shooting higher, and at the same time see this one start to move down, and I want to see something like this. But right now with these lines both flatline, I'm not interested in anything with that. All right. And then we've got something like New Zealand Canadian. Again, we had a long entry back here. There hasn't been anything else since. Uh, the price looks like it's trying to go down, but there has been no short signal here yet. All right. Even though it's coming down. And again, this is one of those things where, if you're going to stick to the methodology, you have to stick to it. Right. And there's no trade here. Eventually, if this is going to be a good downtrend, eventually what's going to happen is this Canadian dollar line will start to hopefully move up. And this looks driven right now more by weakness in the New Zealand than strength in the CAD, because the New Zealand's moving down, the CAD is sideways, and that is causing the market to go down. So, like I said, this move is being driven, this little downtrend is being driven by weakness in the New Zealand, kind of neutrality in the Canadian. But, obviously something like this, where this crossover, that would be a great signal. But as it stands right now, not great. But a lot of that, again, is because we're using such a high look back. If I change this to like 14, let's see what it looks like then. Yeah, I mean, even on the 14, I guess there was a sell signal here, but it's not great because then both lines are heading down. And like I said, to me, it's not really worth it. Again, I've got 21 other currency pairs I can look at. I will find something, and if I miss out on a trade, then so be it. Eventually, there will be a sustained signal that I can take. This one here, even though they didn't come together, again, this is more of a judgment call, because you can see they came pretty close together and they're trying to diverge off of each other right here. And this isn't a downtrend. So this is another New Zealand pair. Maybe this is the one that you want to take, right? Because even though you didn't get a crossover, you do have a downtrend and then a squeeze back together and then a divergence off each other. They didn't come together. You still got this space in between. So this is another one where you've got to decide whether this space is concerning, whether you want to hold really tight to the rules and say, well, they didn't touch, so I'm not taking it, or whether you just say, I'm willing to take the risk. And it probably wouldn't be a bad trade. All right. And so on and so forth. New Zealand USD actually did give you a sell signal back here, and that one you could have still been holding, and so on and so forth. Not going to beat a dead horse here. So, this is the dollar Swiss. Again, long position way back here. You could still be in this. We had this big pullback yesterday. Actually, this was during the London session. We can see we've recovered, and I'm assuming this will probably just keep going up. So, all right. So, so I just wanted to talk about that and just talk about, again, playing around with the settings, playing around with the time frame. Now, I probably wouldn't use an 89 period or even a 50 period look back on a daily or a weekly chart. Again, it's going to be way too slow, and you will get very few signals. And even when you do get them, you probably will get in at the wrong time if you take it strictly off that chart, because by the time you get the signal, it's a lagging indicator. Price has already probably moved, and then you're probably going to be likely facing a pullback at least. You're going to enter into a big drawdown, and you're going to sit on a huge drawdown for probably an extended period of time. So I wouldn't advise it on the higher time frame unless you want to use multi-time frame analysis. Let's say you get a signal on the let's go to the weekly chart. I haven't done this, so I'm just going to show you now. Okay. Here's a sell signal right here. I mean, this one probably would have worked out. We had a sell signal here and price went down. Okay, we had another sell signal here. Nothing there. Okay, here was a sell signal right here. The price actually went up that week, so that's not one you would have wanted. So again, what you could do is, If you see the signal on the weekly or the daily chart, then maybe drop to your 4 hour and say, okay, has price already made a huge move in that direction? Then I want to wait for a pullback. Um, and then that's fine. Then you can wait for the pullback and then go in, and your signal on the higher time frame will still be valid. You're just waiting for a shorter time frame pullback. So there's a lot of different ways to do it, but I personally wouldn't use a super high look back period on a high time frame, but you certainly can. You can just see on this pair alone, I did find a couple of valid trades. And sometimes it will just move, but your signals are going to be way fewer and far between. Okay. This is a weekly chart. All right. So we had let's just look from here. We had a buy signal. This was in April of 2022. We got a sell in 5 months later in October of 2022. And then we didn't get another signal until May of 2024. So like a year and a half later before we got our next signal on this pair in, like I say, May of 24. And then in March of 20, so almost another year later before we got this sell signal. So you can see you may go anywhere from 6 months to maybe a year or two before you get another signal because you're on a weekly chart and using a high look back. Now, if you're okay with that and you don't want to look at charts more than once a week and you just want to kind of position trade, then it's great. I'm not saying don't do it. I'm just saying, the volume of trades you're going to get and the action you're going to see is going to be way less. And some people just can't do that, because you're going to want to be in the market and therefore you're going to maybe take trades that are not really there, not lower quality signals. And if you take a lower quality signal on a daily or weekly chart, you're going to get creamed. You just will. So I would just rather, use like a 4 hour chart. I can swing trade those. And I still have the long look back period where it still filters out a lot of garbage. But I will almost definitely get at least one trade a day that will set up just based on the fact that it's a 4 hour chart. And some days I don't. Some days there's nothing. I just don't like the looks of any of them, or it's heading into the wrong time of day or heading into a holiday or something, and I just won't bother. So, you have to kind of play around with it. But I just want to, again, stress it's a great indicator. Ultimately, no matter how you use it, whether you want to use a short look back period, even down to a 7 or a 14 period, or whether you want to really stretch it thin and go even higher, 50, 89, 100, the higher you stretch the look back period, the fewer trades you'll get, the more, potentially the better quality trades they are. But again, the longer you stretch it, you risk, late entries, even on a short time frame. I make this like 200, which is kind of crazy. On this pair, you get this short right here on November. Oh, we're still on the weekly chart. Let's go to the 4 hour and look at that. This is a 200 period look back. We get a long here. This was in March. And then we get nothing until, it's about a month later. We get this little short position, but look how late it is. You get the signal way down here. So, I mean, you can stretch it out, but your entries are going to be later. And so I think, you can compromise and do like a 50 to 80, 50 to 100 period. And that's going to stretch it out enough where it'll filter out a lot of the junk signals, but not make the entry so late. And that's the problem with stretching this thing out. It looks great in hindsight when you nail one, but you will take late entries. So anyways, go ahead and play around with that. And if you guys have any questions about this indicator, certainly let me know. And I'm going to leave it there. I've been talking long enough. Make sure you smash the like button on your way out. Subscribe to the channel. Any questions or comments on any of this or the future stuff or the indicator or anything else for that matter, drop it in the comments. And I will look forward to talking to you guys again, hopefully tomorrow. All right. Have a great night. Talk to you all soon.